everybody, just kidding about that 15%. I know your money's already in our account, but you're going to get 12, not 15. That was the last thing that we wanted to do. So I remember being on a Zoom call with my three partners, and we brought some of our mentors on board. One of my other partners was also in a coaching program. We had his mentor on the line. We had my mentor on the line. So 6 guys on a Zoom call, and we're all just trying to figure out, what are we going to do? What's the best way to move forward? At this point, between earnest money, extension fee, and everything else, we had about $150,000 on the line, so backing out wasn't a pretty option.
As an operator, I know other investors are romanticizing multifamily investing, and I'm looking to learn from other investors' mistakes. I know you are too, and you found the right place. Welcome to Myers Methods Presents Multifamily Missteps. Hey everybody, and welcome to Myers Methods Presents Multifamily Missteps. I'm your host, Jerome, and I've got the great pleasure of having Brian Briscoe with me today. How are things in the DC Metro, Northern Virginia area?
Hey, DC Metro, Northern Virginia, we're all doing well here. Hunkered down, everybody's staying at home. Freeways are amazingly clear, so it would be theoretically a great time to be out and about.
So, do me a favor, tell me how the listeners could get in contact with you.
Easiest way is our website, fouroakscapital.com. There's a click here, somebody will contact you, link. If you want to contact me directly, brianbriscoe at fouroakscapital.com.
Awesome.
Yeah.
You're going to want to contact Brian. He's on a rocket ship. I think they've closed 3 deals in like the past 12 months or something insane like that.
4 deals in the past 9 is where we're at right now.
Jesus.
Yeah. So,
I mean, how does somebody do that? Brian, tell us the story. What's your background? How'd you get into multifamily? How do you close 4 deals and a couple of 100 units in 9 months?
So background, I'm one of those guys, and a lot of people have similar stories, but, September 11th rocked my world. I was, 24-year-old at grad school, and, it fundamentally changed, my outlook. I was a reservist in the Marine Corps at the time. And, I had gotten into the reserves for many reasons. It was kind of a way to broaden myself professionally, help me with some leadership skills and things like that. But when the World Trade Center went down, it just was one of those things. It's like, okay, I'm already a Marine, something's going to happen. So instead of waiting for my reserve unit to get called up, I took things in my own hand, decided to go active duty. And, amazingly, unbeknownst to 24-year-old Brian, 19 years, 20 years later, I'm still active duty, which wasn't the original plan. But anyway, along the route, I think it was probably about 6 or 7 years ago, right around the time I hit my 12-year mark on active duty, that I decided that, I've gone far enough that I might as well hit that 20-year mark to get the pension, and so, I'll get 50% of my base pay for the rest of my life, just by serving for, what's now 1 more year. But at the time, that was kind of my line in the sand. So I hit the line in the sand, and, I just pressed forward. And the idea was, okay, I got plenty of time to think about stuff. Anyway, fast forward a couple of years, right before I moved here to the DC area. So this would have been like 2017. I kind of realized that my time in the Marine Corps would eventually come to an end. I for the first time saw that light at the end of the tunnel, and I knew that, being transferred to DC area, transferred to the Pentagon here. I left in 2018, I could do some rudimentary math. I knew that would be potentially my last move until I hit my 20-year mark. And I happened to have a really good boss that was very, very focused on making sure the Marines who were getting out of the Marine Corps had a plan on what they were going to do post Marine Corps, so that they weren't just, getting out of the Marine Corps and then thinking, now what, so I started planning, and I always liked real estate. I had a handful of single family homes that I picked up along the way, and they were, kicking out cash every month. And so I wanted to figure out a way to scale. So long story short, I like the idea of multifamily because it scales. Joined the Michael Blanck coaching program, which I think was like jet fuel to my trajectory is what it was. I was already committed to doing it, but getting into that, it's a paid mentorship program, but getting into the paid mentorship program, for me was like jet fuel because it just accelerated everything that would eventually happen. I found a couple of great partners. We got, Todd Butler, Eric Shirley, Brian Mallon, that, I found through the Michael Blanck coaching program. And, that eventually led us to, deals number 1, 2, 3, and 4, which we closed, I think, just over 3 weeks ago. So yeah, that's the whirlwind story.
Wow. So, I've got to ask, right? Because the majority of people who go through these coaching programs don't actually have a ton of success. And I see you as somebody who's getting tuned in the boat already. So
yeah.
What is the difference maker between somebody who does one of these 5-figure mentorship type programs and the people who don't do it?
Yeah, I think it's commitment. And there's a lot of people that I've met through this program that have an idea that paying for the mentorship program is going to make them successful. And I think the way that I looked at the program was exactly like I explained. Is it was just throwing jet fuel into an engine that was already, running on 6 or 8 cylinders, whatever you think I've got under the hood, but we'll call it a 12-cylinder engine. But, I think you have to be committed to succeed first, and you have to be committed to the actions that are necessary to succeed. And like I said, I think a lot of people think that the mentorship programs are, a magic wand, where it's like, well, I paid for this mentorship program, so, where's my first deal? And that's quite the opposite. I mean, I think the mentorship programs give you structure, give you framework, give you advice, but end of the day, it's still, incumbent on each individual to chart their own path, to make their own success, to spend hours and hours on the phone talking to brokers and property managers and everything else. So yeah, I think you're absolutely right. And I've seen several people in many mentorship programs that, end up on the opposite side of the fence, where it's just like, yeah, I tried it. The mentorship program didn't work for me. And sometimes some people I talk to them, maybe it is the mentorship program. Maybe it just wasn't a good fit for them. But a lot of times I think it's the person not working for the mentorship program.
Yeah. It's sad. I get a lot of calls where people are like, yeah, it didn't work. And now the acquisition fee that I thought I was going to get to use to pay down the credit card or some of the other things isn't going to happen. And I'm quite sure what I'm going to do with the equivalent of car debt that I don't have a way to pay for it. And so I always caution people on it, because they're not going to do it for you. Right? And they're just there to help and support you and guide you along the way. But you got to push your own car, right?
Yeah. And I mean, a lot of people talk about, putting, investments like that on their credit card. And, that scares me, to be honest with you, putting that money on my credit card. Now, to be honest with you, I did put it on my credit card because, I get like 2% cash back, but I immediately paid it off. I would also say, if you're going to do a program like that, you got to start from a position of strength. You can't be broke, and throw it on your credit card and then expect things to happen. I had a couple of single family homes. I sold those single family homes to be able to launch my multifamily career, so to speak. So I sold one house, paid off all my debt, and used $25,000 to pay for the coaching. And then just after I got into the coaching program, I sold the other house, had another 6-figure payday. And I mean, that money was our earnest money deposit and everything else. So, I think that definitely contributed to it because, when you're getting into multifamily, that earnest money deposit is, can be, insurmountable for some people. So if you're putting money on your credit card to pay for the coaching program, now when you're getting something under contract and you've got to put 1 to 2% down, potentially non-refundable, where's that money going to come from? So I think some people just aren't quite prepared for it and don't understand, the big picture.
I agree with you 3,000%. And I challenge the educators out there who say you can do this business with no money down, no credit, no experience, no nothing, no problem. I think there's some more that you have to tell people along the way, because it's not a poor man's game by any stretch. And anybody who's had a misstep knows that those missteps usually cost money.
Yeah.
If you don't have any money, you're in trouble because you've got to have money to continue the project.
Yeah. Yeah. So speaking of people who practice what they preach, a friend of mine that I met through this business, James Ray, he does have a coaching program, and he specifically told me one day, he's like, yeah, I teach my students that they can do exactly what you said, where they can buy stuff with little to no money down. He's like, and a year or so ago, I realized that I wasn't practicing what I preached. And so he converted all of his acquisitions to where he was using the system that he was preaching, and, I got mad respect for him for doing that. He's like, I was going out and syndicating, and, we have, X amount of units already. We got money in the bank. We're able to just, fund sometimes the entire down payment. It's like, but I realized at one point I was teaching all my students how to do it without money, and I was not doing that. So, he changed his approach, and, yeah, so
Kudos.
it can be done.
I'm not a believer, but that's and so you've got a bunch of choices on deals that have been done. I'm sure all have been absolutely perfect. You don't have anything to share with me today from a misstep perspective, do you?
No, of course everything's perfect. I mean, why wouldn't it be? Obviously we've had our share of missteps, and I joked about this earlier is, I mean, you extended this invitation out to me, a couple of months ago, and I seriously meant what I said is I hadn't accepted the invitation because I couldn't decide which one of the many that I wanted to share, so, but I think the one that, kind of set a course for us would have been our first deal. It was a small portfolio. It was a 16 unit and a 39 unit. So a total of 55 units, Spartanburg, South Carolina. And, it was a pretty, pretty well located, downtown Spartanburg. Upstate South Carolina is like the fastest growing area in South Carolina. South Carolina is one of the faster growing states in the union right now. I saw a recent, just to give you an idea of the growth, a recent U.S. Census press release said that Spartanburg was the 19th fastest growing city in the United States right now. So it's in a downtown that's being rejuvenated, in a city, in a county, in a state that are all growing. So for a lot of reasons, the deal made sense. So we underwrote it, we liked it, we got it under contract, and I think the biggest hiccup we had with that property was the loan. And going into it, we had our idea of, what that loan was going to look like. And the prevailing rates at the time, this would have been just over a year ago, year and 3-4 months ago, prevailing rates at the time were about 5% for a Fannie Mae loan. And fortunately, they were 5% when we started. Otherwise, this may not have been possible. But we get it under contract, and we had overestimated the proceeds that we would get from the loan. And not just by a little bit, so we were talking to brokers, and brokers were saying, yeah, on a Fannie Mae loan, you can get 75 to 80%, loan to cost, and they were talking about, you know, 75% loan to value plus up to 5,000 per unit in renovation cost financed in. And so that's how we underwrote it, 75% loan to value plus 5,000, and end of the day, we're looking at a $4 million purchase, and we're looking at about a $3.5 million loan. We're thinking, man, this thing's just, juicy. It's going to be this great deal. The returns are off the chart. We underwrote this thing at like 22% average returns, in a time where, yeah, I know, at a time where most other operators were in the mid-teens. And I remember at one point, and I'm glad we did this, we said, well, everyone else is saying mid-teens. Let's just say mid-teens ourselves so we can, under-promise and over-deliver, But so we get the place under contract, we start, start working due diligence and everything else. And what we didn't realize is there's this thing called a debt service coverage ratio. We were just going straight off of this 75% LTV and, knowing that there's this debt service coverage ratio, but it just, being brand new to the game, we were just going off, 75% LTV plus 5,000. We're going to get it. And then we gave it to our lender, and she comes back and she's like, hey, we can't give you anywhere close to that number, and the original number we thought we were going to get was like 3.6. And, she came back with a fairly good number, but it was like 3.3, end of the day, and we're like, okay, that's still not bad, so we went from thinking we were going to raise, 1.2 million to having to raise 1.5 million, so, and that, I wish that was the biggest hurdle we had to get over, with this loan. But we signed the loan documents, we paid the application fee, and speaking of, any wannabe syndicator, $10,000 is the application fee for, a Fannie Mae loan, and we were getting two of them, one for each property, so 20 grand later, we've got the loan application in. And, what happened in 2019 is, the rates just bottomed out. I mean, they went down and down and down, we're looking at this. And here's the cool thing. As the rates go down, our debt service ratio gets even better for us, So at one point, I don't remember the exact numbers. I think the original loan, what they originally offered us was closer to 3 million. But at one point, looking at the debt service coverage ratio and the rates and where we were going to fit in, we were back up to like 3.3, 3.4 million in proceeds, because, the rates were low, our debt, the debt service number was lower. So our ratio ended up being higher. So, we thought we were fat and happy. And then come September and, started, I'm sure it didn't start with a tweet from President Trump, but he started tweeting about how Fannie and Freddie needed to be deregulated and things like that. And then pretty soon it started coming out in the news where Fannie and Freddie were hitting their annual caps for how much money they could lend. And, so lending came almost to a screaming halt. We were a week or two away from closing. And, we had a 7-figure bank account from the money that we had raised. Things were going well, and then I get the call from my broker and she's like, yeah, your proceeds took a big hit. I'm like, what do you mean? She's like, have you not been paying attention? I'm like, yeah, I mean, I know Fannie's coming up to their lending, limits, but we're good, right? She's like, no, you're not. I'm like, what do you mean? What are you talking about? She's like, well, to slow down lending, they added, over a full point to interest rates to get people out of the game. And I'm not kidding. Overnight, we went from a 3.8 interest rate to a 5.15, so 1.25% was added to our interest rate. And what that did to our debt service, it just crushed us. Our proceeds went from 3.3 to 2.5 million, all in a 1 week time frame. So that had us reeling. It was just one of those things like, how can we, so, we played some some shell games with the lender, and the lender was in on this, so we figured a couple of ways where we could, leverage appraisals and tighten budgets and still make things work. We got a couple $100,000 back in proceeds, but end of the day, that just crushed our projected returns, and we had advertised everybody somewhere around a 15% return, and we recooked the numbers, and that number ended up being like 12, and we're just like, oh my gosh, what are we going to do? And I remember.
What's up, guys? It's your host, Jerome. I just want to let you know we launched Myers Methods in the fall of 2019 with the ambition to inspire a new breed of multifamily investor. If you are interested in getting into multifamily or scaling your current business, hop over to our website at myersmethods.com to grab your free 4-step guide on how to get the ball rolling in multifamily. Now let's get back to the episode.
Yeah.
Hold on. So your proceeds went from 3.3
to 2.5.
So you had $800,000 that you hadn't planned on finding before?
Yes. And we went from 7-figure bank account, we're closing next week, to, oh my gosh, are we going to be able to close? It was basically where that put us, so fortunately, we had a couple of things happen after that. Rates did ease up. We ended up getting about 2.9 in proceeds. So it wasn't as bad. We were able to negotiate back up. We ended up locking at a 4.9 instead of the 5.15. So we ended up getting a quarter point back. Ended up getting 2.9 million total in proceeds on a $4 million property. So, the debt service ratio ended up being about 70% LTV, but we weren't able to finance the renovation costs in there because of the debt service. But it just made us sick. We did not want to go back out to the investors and say, hey, everybody, just kidding about that 15%. I know your money's already in our account, but you're going to get 12, not 15. That was the last thing that we wanted to do. So I remember being on a Zoom call with my 3 partners, and we brought some of our mentors on board. One of my other partners was also in a coaching program. We had his mentor on the line. We had my mentor on the line. So 6 guys on a Zoom call, and we're all just trying to figure out, what are we going to do? What's the best way to move forward? At this point, between earnest money, extension fee, and everything else, we had about $150,000 on the line, so backing out wasn't a pretty option. We were prepared to if the numbers, looked that way. But at one point in the game, one of our mentors just said, hey, I know you guys have played with a lot of things. He's like, have you changed the equity, the GPLP split yet? We're like, no, we have. We'd played with the acquisition fee. We'd played with disposition. We'd pulled so many different levers. He's like, why don't you change your deal structure? And we were currently, I think we started with a 6 pref at a 70-30, investor to LP to GP split. And basically what we had to do to bring our returns back up to the same level we had projected is we went to a 90-10 split. So, and what that does is it completely reduces our payday, so, now instead of a 30%, equity position, or it's a promote, I think is what it's officially called. But instead of that 30%, ownership, we cut our ownership down to 10%. And when we hit that 10% mark, put things in the gonculator, and it came back saying projected annual returns for our investors was still around 15%. So end of the day, the way we ended up fixing that was just moving the needle to where our investors got the lion's share of the returns. And, as a GP, we're not going to make a whole lot of money off this deal. And then you might say, what about that extra money that you had to raise? You're shaking your head. Yeah. But from there, we had somebody that came in clutch for us, who literally called me up and said, I've got a couple of investors that are looking to get into a deal. What do you got? So, got on the phone with the attorney, figured out a way to, make sure we did it in accordance with the SEC regulations. He brought a couple $100,000 in capital. And then each one of us, out of the four partners of Four Oaks Capital, each one of us dug into our back pockets, so, I think between the four of us, we put another $250,000 to $300,000 back into that deal. So we ended up in a good position. But like I said, the numbers don't look very good for us as far as a GP on that deal. So, we're going to do everything we can to make sure the LPs are still getting their 15%. Because we want to keep every single one of these investors. We want to make sure they're happy with us, because our business lives and dies off of, what the investors think about us. So, we're going to do everything we can to hit that 15% mark by our exit, in 5 to 7 years is what we advertised. So, we'll hit that 15%, whether we get paid or not.
So this is why I say this isn't a poor man's game, right? Because you just said that, between the four partners, you guys put another 300 in
Yep.
on top of whatever you had in before.
Yes.
So you had to close the gap. And I just can't put together how somebody with no money can actually do these things, right? Because anytime there's a shortfall, it's always going to come back to the GP, right? And there may be some people who are willing to invest some, but they're not going to take care of everything. And so, you guys are taking extreme ownership. I guess it's the Marine in you, right? So, we're going to get this deal done. We're committed to the mission, and the mission is going to be achieved one way or another. The other thing that I think is really insightful, and you guys demonstrated some serious wisdom, is, hey, this thing's performing at 22%. We don't actually need that, so let's show something a little bit less. And then it's like Murphy's Law or something. It doesn't matter how much I think it's going to cost or how long I think it's going to take. Even if I add fat on, I still need some more. It's just like, it's always just out of reach. But, that's why I think it takes some real fortitude and some intensity in order to be successful in this business. So I definitely appreciate you sharing this story. And so you guys got the deal done. You guys are operating it now, executing your business plan. What could you have done to prevent this from happening?
Well, part of it was just, have a more, brass tacks conversation with the broker, and, knowing what I know now, we would have, made sure that we shared the full story with the brokers. I mean, I was going off of, Franny, you can get up to, and that's what the brokers would use every time, up to this LTV or up to this amount of LTC. We make our lending partner, and that's what they are. Whoever is providing the money for this is one of your partners. We are consulting them early and often. So if there's any change to the financials, every time we get a new month's T12 after every month, we're sending it over to our broker, and it's just like, hey, this is what we got this month. We're under contract with this deal, or we have an offer in on this deal. How does this affect the lending situation? So we're just having a much more detailed and, we're coming from a position where we know what we need from that lender. We need to have, solid numbers and commitments, not very vague up to percentages. And there are things that fluctuate, rates fluctuate daily. Most agency loans are based off of the LIBOR, the London the bank rate. But the LIBOR is what those all fluctuate on. But, there's a lot of variables there. So we want to make sure that we're meeting the debt service, ratio requirements. We want to make sure that, we know what levers are going to change our proceeds. And we also want to know how sure the banks are with those proceeds, you know. So we underwrite with a lot of fluff, you know. So if we think we're going to get, you know, 3 million in proceeds, we'll underwrite less than that. If we think we're going to get a, you know, 4% interest rate, we'll underwrite at a 4.5, you know, or 4.25. So we add a little fluff in there, you know, and we've learned the same thing with our renovation budgets. You know, we're putting a little extra fluff in our renovation budgets as well, so that when we're underwriting, there's multiple layers, so to speak, multiple buffers there that just help us come in with a more conservative projection.
Awesome, awesome, awesome. And so just to kind of wrap everything up on this one, so there's two ways that your loan proceeds can be cut. One is loan to cost. The other is your debt service coverage ratio, and that's a function of the income,
Mm-hmm.
the net operating income that you bring in on the property. And
Yep.
so most banks want you to have 25% or 30% above whatever your net operating income as
Yep.
your cash flow. And so that allows you to pay the bills and pay them and have some money left over for you.
Yeah.
This deal was constrained by the cash flow, which probably suggests that the rents were below market and they had an income problem or an
Mm-hmm.
occupancy problem. And so
Yep.
then his team's going in and they're
Yeah.
improving rents, right?
And in this case, the rents were way under market. We still have, you know, we had our company call this morning. We are like counting down the days until a couple of leases end, because we've got some one bedrooms that market rate is between 750 and 800, and they're paying like 5.25. You know, because the previous property manager, or it was the owner, it wasn't the property manager. The previous owner didn't want to raise the rates. You know, so when somebody was in, that was their rate forever. You know, we raised one guy's rent $350 a month, and he's still below market average. You know, he was paying $400 a month on an apartment that would go for $850. You know, and you know, the property manager explained it to him. It's like, look, you've been getting a great deal for 12 years. You know, and the deal we made with him was just that. It's like, we're going to come up. It's not going to quite be market rate, but we're going to have to come up on the rents. And we gave him the new number. He complained. Then he came back to the property manager 2 days later and he says, I can't find anything within 20 miles for the rate that you just gave me. So I'm staying here. But so yeah, it was debt service constrained because the rents were so far under market. But that was the value add component to this deal. Was it wasn't being managed efficiently. So come in, raise rents, which we've been able to do. You know, do some minor renovations, which we've been able to do. And then, you know, in 5 to 7 years, you know, put it on the market and see what happens.
And so I always get a kick when people say, hey, you can't raise rents in the middle of a pandemic. And
Mm-hmm.
you just gave a really strong example of impact you guys are being able to make. So, uh, you know, with that said, my last question is, what words of wisdom do you have for the listeners?
I would just say sharpen your pencil, you know, on everything. You know, when you're going through your underwriting, when you're going through your projections, you know, make sure that there's no I think, or make sure there's no assumptions in there that you have not verified. And if there's still assumptions that exist, realize that you're always taking a risk when you make an assumption. So know what those risks are, you know. And you know, fortunately, you know, our assumption, you know, it didn't hurt the deal, it didn't hurt the investors, it hurt our back pockets. You know, we're going to get paid less on this deal, but sharpen your pencil on every single line of that pro forma. You know, make sure you know what the property taxes are going to be. Make sure you know what the insurance costs are going to be. Make sure you know, going forward, and you're not assuming based off of, you know, their T12 or the broker's pro forma.
So this was your first deal. How long
Mhm.
did it take you to get this one closed?
This took a while. There was, you know, I'm smiling about this, but the seller started the contract, you know, and the seller sent us a contract. And instead of measuring the due diligence period, instead of measuring the contract in calendar days, the seller measured everything in business days. So we had originally had a 90-day close plus a 30-day extension. And since he measured it in business days, we had, I think my broker called it an ungodly amount of time, but it took about 6 months to get it closed. And because we had this, it was our first deal. And because we knew we had a lot of extra time, when the big decisions came up, we always said, we got time, guys. Let's call some people we trust. Let's ask them the questions. Let's make sure we're doing the right things. So, we deliberately took that one slow. In hindsight, had we sped up a little bit and closed in August, we wouldn't have had that big pinch at the end. But it took about 6 months from contract to close.
Beautiful, beautiful. And then the law of the first deal went into effect, and you closed a bunch of others in like 20 days, right?
We had the next two under contract in the next probably within 30 days of closing that one.
Beautiful, man. Brian, I really appreciate you sharing those jewels of wisdom with the listeners. I look forward to continuing to build and deepen our relationship, and I look forward to a long, healthy, and prosperous career with you in multifamily. We'll talk soon.
It's going to be fun. We will, definitely. Thanks.
You made it to this juncture, so you really love what we shared on this episode of Myers Methods Presents Multifamily Missteps. Do us a favor. Give us a 5-star rating. Give us a review. And share this with somebody who's interested in multifamily investing. Until the next time, the pack is with you.